All right, so tonight we're going to talk about some insurance things, not life insurance, but the other stuff, auto and home insurance, medical insurance to the extent we can. Medical insurance is it's going to change, based upon the election, based upon a lot of things. So anyway, we'll get more into that. First off, on the midterm though, midterms can be opened up next week. Um, you have no need for a proctor for that, right? You just open up Blackboard, you just take the exam. So that's pretty straightforward. But there's a separate review tape and or tape, whatever, video for that, and it'll go through and kind of focus your study a bit. All right. So homeowners insurance, property insurance, just the whole concept of insurance. Insurance is based upon the fact that not everybody is going to have a bad day on the same day, right? Not everybody's going to wreck their car. Not everybody's going to, have something happen to their home. Now, there's some exceptions here. One, possibly would be fire, but even fire is generally, at least back in the old days when people used to take care of forests and other, we could get all political on that one too. But anyway, it didn't used to burn down entire towns. But floods, on the other hand, floods can do that, and that's why flood insurance is not offered by private companies. They may be, kind of an intermediary or whatever, but all they're doing is reselling the federal flood insurance. Because the concept of insurance, like I say, is based upon the fact that insurance companies can make money by taking your premiums and having these actuarial people who will calculate the odds of something bad happening to people and setting a fair premium. And when something bad does happen to that one policyholder, they can pay for that claim and go on and make money. If they try to do the flood insurance, what would happen is the insurance company would make a ton of money until there's a flood, and then they'd have to pay everybody at once, and they wouldn't have the money. They'd go bankrupt, and they would have already taken all your money, but now they wouldn't be able to pay you, and so it's just that's not insurance. The same thing could be true of healthcare, and this is going to be very controversial, but like pre-existing conditions, that's not pre-existing conditions are a different thing. That's not insurance. If you've already had something happen, then you can't insure against it. You can't have a wrecked car and then go to the insurance company and say, "Hey, I've got a car I want to insure, and oh, by the way, it's already got some damage to it." That doesn't fall in that concept of being able to do financially. But obviously, health insurance is quite a bit different than property or auto insurance, and so there's other programs, but that's more upon a welfare kind of concept, not a business kind of concept. So anyway, um, other insurance you can get, yeah, protect yourself from liability. Liability means you did something that caused somebody else some harm, or at least their lawyers can say that that's what happened. That's their story. They're sticking to it. And so you, depending upon the amount of assets you have, um, you have a need for that insurance that's going to increase based upon liability. And there's also liability like an auto insurance. There's a legal requirement for you to have liability insurance in case you hit somebody else's car. The government, society, whatever, they don't care what happens to your own car. That's your problem. But if you're going to be out there on the road and potentially hitting somebody else's car, um, then liability insurance, is deemed a necessity. So anyway, um, so risk is just a concept. I mean, what? Um, I mean, it's pretty. There's no other word that really kind of sums it up. I mean, we all know that risk is something that exists. You can minimize risk. You can try to avoid risk, but then again, you can't really live your life if you're completely avoiding it. I mean, to completely live a risk-free life would be pretty much impossible. But even to really avoid risk at all cost would be, basically not to drive, to stay inside, and at a certain point, that's That's just not acceptable. You're just not going to be able to get done the things you need to do in your life by completely avoiding risk. So, yeah, you try to reduce risk, or perhaps you get somebody else to accept the risk, like the insurance company, and they're more than happy to accept it for some remuneration, a little bit of money for them, and they'll transfer part of that risk. And the way you do that is you pay them a premium, and it for big numbers, they're insuring millions of folks, and it does make business sense because, like I say, not everybody's going to have a bad day on the same day, so they can actually make money in it. And one of the ways they really make money is even if they gave out the same amount of money they took in, just the fact that they have your money, that you're paying your premiums for year after year, and maybe at some point, some of it comes back to you in terms of reimbursement for damage. The fact that they were able to use your money, and they're smart people and they can invest it and do things with it, they're able to make money. So economic impact, yeah, we're not going to go there. Obviously, for most of us, we're going to have insurance regardless of what's going on with the economy. Types of insurance, so property, so that could be for auto, home, casualty, life insurance, and health insurance. Um, just kind of an overview. So you can get disability insurance, medical insurance, homeowners insurance. A lot of times, this insurance, you may not have a choice in it if you have a loan on something. You know, if you own a bunch of money on a car, you really don't own that car. The lender owns that car, and they want to make sure that their asset is protected. So, as a condition of you having that loan, you also are going to have insurance. And the same with a home. They're the collateral for that loan is the home, so they want to make sure that their home is protected. And sometimes they'll even do this too, though. This is what I was talking about, where they have, credit life insurance, and they act like they're doing you a big favor by giving you a life insurance policy for the mortgage. Um, Oftentimes, that's just to secure their interest. They they have a loan on your life because you know I'm not saying they absolutely don't care what happens to you, but financially, you know, your death that doesn't want to spoil their investment. So anyway, it gets pretty mercenary. Role of insurance agents. Eh, Sometimes this can be less and less. There's a little something for the effort that all these guys charge, and more and more things are going to be online. And I was watching the thing that's really interesting is about Tesla and how they're doing sort of a vertical integration and eliminating the insurance companies altogether. And it's anyway, we'll look more at it, but that may be the way of the future. So reason insurance is expensive has increased in recent years. Personal injury attorneys. So I know quite a few attorneys. I mean, they're obviously they're whatever. But there's a couple that I actually do kind of like. But these guys, again, they'll fully admit that that's the nature of their business. They will find liability where you think, for example, a lady hit a moose and they can't sue the moose. And the driver is kind of a victim herself. She was just driving the car, but the passenger got injured, and so well, you can't sue the moose. You can't really sue anybody else. All you can sue is the driver. So guess what? They put all the blame on the driver, and her insurance company pays the bills, and the personal, you know, injury attorneys are the ones who do that. So I mean, I'm not saying we need a world without attorneys, but in certain occasions they definitely do raise the price because they're going to get a pretty good price for that. Auto insurance provisions. So contract specifies the insurance, particular vehicle. So different vehicles, different drivers. The rates are going to change. Again, this is based not, they're just looking at the odds. They say, oh yeah, a young male driving a sports car. I mean, they're just looking at the numbers and they're going to say, yep, the propensity for us having to pay and pay dearly is going to be higher with that person. Whereas, somebody, let's say, 50 years old driving a minivan, um, is probably not going to cause them a great deal of problems. Uh, Rates do tend to go the other direction with really old drivers because again, they tend to get in more accidents as well. So, numbers are always quoted in a certain way. They'll a series of three numbers, and we'll look at that how that's done. But liability coverage, bodily injury. So we're talking medical things, and then property damage. So property damage can be, the your car, the other car, or you take out some guardrail, you will find out just how expensive that is. So that's how it's quoted, 100, 350. So the 100 would be the, per person, 300 all the people combined, and then 50 the vehicle. But you'll look at some of these numbers and you'll realize these are minimums. Um, if you get just the minimum, let's say 50, which is actually pretty high based upon some of these numbers, in terms of minimums, you could greatly exceed that 50,000. And then all of a sudden that's on you. That's the insurance company they're going to pay their 50 grand and, you stack, $120,000 worth of cars. They're going to come after you for 70 grand. So you may not want to stick with the minimums. Medical payments. So look at some of these numbers. I mean, Delaware, for example, 15, 30. I mean, medical expenses, you can zoom through that in a hurry. And 5 grand, that's nothing. So you probably do not want to go with the minimums. But this order where they're quoted like that, that's that's that is pretty uniform. Uninsured motorists. So let's say you're getting, there's an accident, you're not at fault, but the other person is, but the other person doesn't have insurance. So again, you want to be covered. So uninsured motorist. Collision and comprehensive. So collision, legally, I said that you need liability insurance, but there's no need, legal state requirement, for you to have collision. So if you are at fault and it's your own car and you don't have collision, your car will not be fixed. But collision, is kind of expensive, or all insurance is a little bit expensive. And if it's an older car, I've gone without collision in a number of occasions. I drove a Dodge Viper there for a while, and it was worth probably, I don't know, 30 grand or so. Not that much. I sold it for a little more because I was overseas. But anyway, I calculated out with the collision insurance, it was going to cost me over 10 grand a year to have that coverage. And rather than do that, I accepted liability only, knowing that if I crash that car and it's my fault, I'm going to pay for it all. But anyway, it made more sense. Comprehensive is kind of the cats and dogs, theft, hail, riots, which obviously, when's that going to happen? Well, could be coming to your neighborhood soon. So things that you think about, but comprehensive is windshield stuff like that. Things that are not from an accident. Deductible, you can also change the amount you're going to pay based upon the deductible you set. So if you have like $1,000 deductible, which again I've done to try and get the cost down, that means that you pay um, at least $1,000, and then the insurance will kick in. And so the rates really do go down quite a bit because the insurance company knows that you're not going to, be nickel and diming them for stuff. And anyway, it's not that hard to do. So that's auto insurance fees. Um, Here's a bit of a summary. What I was talking about with Tesla is what they're talking about doing is doing more of a vertical integration. So vertically integrating means where a company, builds the car, they sell the car, and in this case, they insure the car. And vertically, they do everything with the car, finance it and everything. Because a lot of these insurance companies have been trying to, they want to put, like, say, something in your car to monitor your driving habits and adjust your rates based upon that. Or they say the rates are more because, your particular car costs more to repair or whatever. Well, with a Tesla, where they've got such a data stream because the thing is so, automated, and it's got obviously a lot of um, crash avoidance type things built in. It's got things that will make it more difficult to steal, the traceability of it. Um, Tesla, if they do the insurance in house, they're claim they're able to do it at a better rate and just kind of push the insurance company aside. And you would have one payment that not only pays for your Tesla but also pays for the insurance. So it could be fairly disruptive in that sector, and it'd be good in my mind. The insurance companies are the the intrusiveness that obviously if you're driving a Tesla, you've already accepted that, and now having your data shared amongst multiple companies, at least you're limited to a single company. Anyway, here's some of the auto insurance provisions that we talked about. I'm not racing through this stuff, but I do want to get to the review for the exam, which again will be in a separate video. So again, characteristics, value of the car, repair record of the car. The Viper again was 42 on the list of 43 cars. Tesla or the Viper was going to be the most expensive too, because it had tons of power, was driven by mainly idiots, and had no anti-lock and no traction control, none of that stuff. So propensity to get in a wreck was quite high. So your age will also, the amount of miles you drive and your driving record. So the more that they can use big data to really drill down in here and see, how many miles you're driving, not just based upon self-reported, but actually, see whether you do panic stops and see whether you speed or the rest of that. Um, expect that intrusiveness to get more intrusive. Location, training, school performance, yeah, maybe. But they've got other data that's probably more useful now that they'd like to have that they can grab. So the ability to get several quotes and be competitive is most people don't have much in the way of brand loyalty. They'll go with what's going to be the best price. But the insurance rates can vary greatly based upon location. Homeowners insurance. Homeowners insurance. Now, what they're going to want to do, if you have your vehicle insurance and your homeowners insurance with the same company, there usually is some sort of discount. So that's one thing they have going for you. They'll also ask you a number of questions. And if you live in an area, say that's has a high incidence of fire or earthquake, perhaps, your distance to the fire station, there's just a multitude of factors, the composition of your roof, the building costs in the area. There's all kinds of things. Um, they list them as H1, HO1, but um, renter's insurance is usually a good idea to have. And the landlord will typically want that too because there's typically a liability policy that's built into that. Condominium, obviously, you only own from the paint inside, so you have no responsibility over the big structure. Replacement cost versus cash value, you will be very disappointed if you don't have replacement cost. Because your clothes, for example, your TV, for example, they'll say, that's a, $1,000 TV, and they'll look and go, that's a couple 3 years old. That technology's dated. it's worth $200, and you won't have the money to replace it. Same would be true on your clothes, for example, where yeah, you may be able to go buy brand new stuff, but they're not going to reimburse you for that new price. They're going to give you some sort of depreciated reimbursement. Personal property. The tricky thing with personal property is that the insurance companies are generally going to win. If you think that, oh, I've got all these guns, or I've got, all this expensive camera equipment or jewelry, and it's all insured for a very low price, you may come to find out that it's not. What's going to happen is they'll generally have categories, and they'll say, you know, jewelry, for example, is insured up to a maximum of $1,000 total in this category. So unless you have an addendum to the policy, they call it a personal property floater or a rider, a contract rider, or something that actually delineates and has appraisal values for that, special, more expensive stuff, you're probably not going to get reimbursed the full amount. Um, so there's where they're talking about the floater, itemized valuables, liability on homeowners insurance. So, somebody comes over to your place and they trip on a rake, or not necessarily here in Alaska, but lower 48, they fall in your pool. If you don't have a proper fence, you're liable. If you didn't have a fence, you're also probably be found negligent. It's going to be very, very painful. And other things, you don't think about, well, just because the house burned down, they're gonna buy us a new house, but it's going to take whatever number of months to get the house rebuilt, and you're going to have to pay out of pocket for a hotel, or maybe there's a provision in the insurance policy to take care of that. Other factors, so the value of the home, the deductible, location, degree of protection, and discounts. So they'll ask you about smoke alarms, they'll ask you about all sorts of things, and burglar alarm systems and other systems um, that will help. Again, though, don't be fooled by these folks. I mean, if you've got say a $500,000 house, and they say, oh, you need a $500,000 worth of insurance, you probably don't. If it's on a couple acres of land, and I don't know your neighborhood, but let's say the land itself is worth 200,000 and the structure's worth 300,000, you really need about $300,000 worth of insurance, because the land's not going to be damaged by any of these perils. The structure is going to be damaged. So they will try and pull that over on you. Homeowners insurance, again, typically written into your mortgage. So, $100 a month or something in an escrow account, and it's paid, and the lender typically wants to see that because they want to make sure that you've got insurance on it. Ways to get it down. Again, increase the deductible, improve your protection. So that'd be adding, smoke alarms, maybe, if you've got a cedar shake roof, one of the older style roofs, you put on a metal roof or something that's not going to cause fire issues. Um, but usually multiple policy discounts will work, and then obviously shopping around. Renter's insurance, talked a little about that. And it's pretty reasonable, typically 100, $200 a year, depending again on what you have. Umbrella, personal liability. So what you typically don't want with insurance is some sort of specific insurance. They'll have some of these medical insurance that you've got $1 million policy against cancer, but you don't want something that's limited to a particular ailment, a particular disease. You don't want a uh, you know liability policy that's limited to a particular set of conditions. You want a more general policy, an umbrella policy that's going to cover everything. So you're getting sued by somebody because they claim that you somehow wronged them. And with an umbrella policy, you generally would have coverage if it's truly a inclusive policy. So broader coverage is better coverage. So that's it for property or property and also auto insurance. There's interesting video that shows just how devious it is with auto insurance and some of the things that are done in that. Pardon me, health and disability insurance. This is going to go rather quickly because health and disability insurance, well, health insurance is changing. The good news on health insurance, you can see that this Affordable Care Act, or referred to as Obamacare, or whatever you want to call it, it doesn't really affect that many folks. I mean, we're talking 3%. So the vast majority of folks have got some sort of medical insurance that's um, provided or paid for or subsidized or whatever through their employer. And so that's a typical way most Americans get their insurance. So, the Affordable Care Act, Obamacare Act is interesting, but in terms of affecting most of us, not so much. Medicare is for older folks. So age 65, definitely a big deal to them, but most of us are nowhere near that age. Medicaid, that's more of a welfare program. And so, when they talk about insuring the poor, that's not going to be done through Affordable Care Act. You got to pay for that. Medicaid is more of a welfare program. And so it's, what is that, 5 times as large? Medicaid and CHIP. So again, infants and things like that. So now we're even a bigger percentage, 22%. And then the Affordable Care Act. The reason of the Affordable Care Act, there's really not a champion behind this act as it stands. It wasn't meant to be a it was meant to be a transitional thing, either over to single payer where the government pays for it all, or a transition to some sort of private insurance um, type thing. But what we've got now is sort of a hybrid that really suits nobody. And deductibles, for example, are so expensive that insurance is meant to prevent catastrophic expenses. Some of the deductibles on the Affordable Care Act are like 9, 10 grand, which for most of us is a catastrophe. So other insurance, 4%, and then uninsured. Now this uninsured, this is not like, oh, these people absolutely can't afford it and they can't get. I don't know what the percentage would be, but the uber wealthy are not going to have insurance like this. They would be basically self-insured. If you are of sufficient means, you don't want a health insurance program because if you get sick, you go to the hospital, you go to the doctor, and you are able to pay cash. And by doing so, you pay about 1/4 what the expenses are because any of the hospitals, any of the doctors are going to charge a completely inflated amount because they're only going to be reimbursed at a very low rate by the insurance companies, by these folks. So if you're actually paying cash, well then the fee can often go down. And the same is true, state of Alaska, for example, is self-insured in terms of vehicle insurance. They don't have an insurance company, and if you had the means, could post a bond, post some money with the state, and you could comply with the legal requirements for having insurance without actually having insurance, just saying you're self-insured. If something bad happens, I'm going to pay for it. And, everybody's covered in that case. So anyway, so there are still, significant number of people who are uninsured, but it's not probably 9%. Health insurance, so private insurance companies or the government. So out of those two groups, um, critical component, well, it's kind of an all or nothing thing here. Most bankruptcies are driven by health insurance. Most people are responsible enough not to spend themselves into bankruptcy, you know, But when you've got a dying spouse, or you're dying yourself, you're like, I ain't whatever. Spend like there's no tomorrow because there might not be any tomorrow. So anyway, hopefully this thing will get resolved one way or another, and we'll get on to a insurance plan that is either in the private sector or more competitive pricing, or a single payer plan, and see how that works. Yeah, they're gonna. These guys are very. Uh, they explain the Affordable Care Act. Talking about people being uninsured and many options. Um, but it there's a lot to it. Location Alaska is obviously quite high. Pre-existing conditions. I'm not going to go back into the thing about pre-existing conditions, but to call pre-existing conditions to say you're getting insurance for a pre-existing condition, call it what you want, but that is not insurance. That's a different program, and so I'm not saying it shouldn't be paid for, but to say that that's insurance is a misnomer. So yeah, rehabilitation, mental health. Um, anyway, a lot to it. I'm not gonna belabor it. Pregnancy, dental insurance. So dental insurance, vision insurance, they're actually more what the ideal private sector insurance would be like, because you do have a fair amount of competition. You have pretty reasonable pricing, especially like in vision insurance. Uh, you know, the market's kind of wide open, very little um, government interference in that, and the market drives um, for the point for even things that may not be insured, like LASIK eye surgery or different types of eye surgery, are actually fairly economical compared to other forms of medical insurance, because they typically, at least on some of the eye surgeries, they're not insured and people are paying cash. So um, the reimbursement is 100% since there's no insurance company involved, there's no admin involved, and it's just between you and the doctor, so prices can actually become quite low. Other things for unreimbursed medical expenses, so deductible, co-insurance, stop loss, coverage limits, coordination of benefits. So a lot of fine print in there that can happen, and the co-insurance thing. If you ever have two insurance companies, I did do that for a while where I had two health insurance companies, and it was the worst case ever because they just wanted to fight about who would pay and who wouldn't pay. And my advice to you is, if you're ever in a situation like that where you've got, say, your spouse or whatever is also has insurance, and you have two companies, that is going to generate some mail and some problems for you. Expenses not covered. So they do have some medical savings accounts, flexible spending accounts, but these plans are going to be changing. We talked about Medicare. I'm not going to go into great detail because most of us aren't quite 65 yet. So Medigap. Sometimes there's some of these government programs have um, gaps or whatever, and there's private companies that will try to fill that gap with a separate policy. Prescription Act, Medicaid. So this would be for more of a welfare type thing, aged, blind, disabled, or needy families with dependent children. Done by the state. So the ACA, Affordable Care Act. Um, yeah, contentious political issue. It's kind of dead in the water right now. The way the Affordable Care Act was funded was by, you know, well, it's not pejorative. It's just everybody's going to be forced to have insurance. So even young, healthy people, like probably most of you all, would be forced to have insurance and pay at a fairly expensive rate based upon your propensity to actually have issues to subsidize the people who are older who already do have issues. And anyway, trying to get the younger people to pay for the older people was that didn't necessarily work when they made it non-mandatory, which happened a couple years ago. Then the plan just sort of falls apart. Long-term insurance. So this would be, you go into some sort of assisted living facility. First off, if you end up in one of those places, there's some actually pretty scary statistics that sort of predate, well, they definitely predate the COVID situation, but uh, this is unfortunate when they talk about people being checked into these facilities and dying rather quickly. That's not really new. If you go to one of these facilities, your odds are 53% of being dead within 6 months. So you didn't check into these places because you were, doing well in the first place. So some people may stay there a while, but for most people, it's not going to be a long-term kind of situation. Anyway, if you have some reason, based upon your family or you have some feeling that you may need this, you can get insurance for it early on when you're younger and maybe be affordable. If you wait till you're actually in a position where you need it, then obviously it's going to be quite expensive. So the factors affecting the premiums, provisions, how complete's it going to be, your age, and do you already have something, some health condition that makes you already leaning in that direction, which is definitely going to affect the rate. Financial situation, health situation. For me, if I was ever in this sort of situation, I definitely would not be here in Alaska. I mean, if you can't be outside to enjoy things, if you're going to be confined to someplace, medical care is already pretty expensive in Alaska. So for me, there's a number of foreign countries that I've spent some time in that are pretty darn economical. So I would probably opt for that. Disability insurance. So there's different programs. There's state programs and there's also private programs. And this means like let's say you're a roofer, and you fall off the roof and you can't roof anymore. Um, there goes your income, right? But you can get insurance to cover you, and so there'd be a state component to that, workman's compensation, but there also may be a private policy, and the private policy may have one or two different definitions. It says, they're insuring you as a roofer, you can't roof anymore, so yeah, you can't do it within your own occupation, and so they need to start paying. But a more restrictive one may say, well, yeah, you can't roof anymore, but you can sit at a desk, you can take a job like that, and so we're not paying until you get to the point where you can't do any occupation. So anyway, there's different ways to define it, different premiums obviously associated with it. So we talked about individual and then the employer. Social Security does cover part of that, which is part of the reason why they're going bankrupt. And then workman's compensation, the state fund that you pay into if you wonder what some of those deductions are on your paycheck every month. That would be one of them. Maybe a dollar or a percentage of your income. So, the concept is if you're disabled, if you can't work, well, your expenses should be a little bit lower. Maybe the medical expenses might be a little higher, but if you're not having to commute to work, if you're not having to have a vehicle, if you're not having to, you know, be away from home all the time, your expenses theoretically should be a little lower. And so they may say, we'll pay you, 80% or 50% of your previous income. Waiting periods, length of times. Anyway, so the private insurance companies are potentially your employer. If there's something that's offered through your employer, it's normally a group rate and it's normally subsidized. And that's kind of it for the material that's going to be on the midterm. So back to the midterm itself. A separate lecture on that though, or not lecture, but I'll kind of run through the questions to sort of point you in the right direction. on Blackboard, so you don't need a proctor. You don't even need to use the RP Now procedures, but you will have, 60 minutes to do 40 questions, which will all be multiple choice. If you don't watch the review video, it's going to make things difficult for you, and obviously you can use a calculator. If you mess around too much with the computer itself, the testing program will kind of shut down if it doesn't take much to get Blackboard to just sort of lock up on you. So, um, based with the time constraints and the rest of it. Um, anyway, if it does, you can, call, text, email me, and I can reset it for you. But if it happens a couple of times, obviously you're having some issues. So that's about it, though. Homework, get that turned in, the first batch before the exam, and you're good to go.